Let me be very clear with you right now. If you're thinking about buying a house in 2026, you're about to walk into one of the most dangerous financial minefields I've seen in decades. And here's what nobody's telling you. There are 5 states in America right now where buying a home isn't just a bad idea, it's financial suicide. I'm talking about states where your biggest investment, your life savings, everything you've worked for could evaporate faster than you can say foreclosure. And if you think I'm being dramatic, you haven't been paying attention to what's actually happening in the housing market right now. This isn't about doom and gloom. This is about protecting your money from a disaster that's already started. So if you care about your financial future, you're going to want to watch this all the way through, because what I'm about to show you could save you hundreds of thousands of dollars. And if you ignore this, well, that's on you. Now, let me ask you something. Do you know why most people lose money on real estate? It's not because they bought at the wrong time. It's because they bought in the wrong place. Location, location, location. You've heard it a million times, but here's what they don't tell you. Location isn't just about the neighborhood or the school district anymore. In 2026, location is about state-level economics, tax policies, insurance costs, and population trends that are literally reshaping the entire American housing landscape. And most regular middle-class families have absolutely no idea what they're walking into. Here's the brutal truth. The American housing market is not one market. It's 50 different markets, 50 different economies, 50 different tax systems, 50 different insurance nightmares. And right now, in 2026, there are 5 states where every single one of these factors has aligned into a perfect storm of financial destruction for home buyers. I'm not talking about a dip in property values. I'm not talking about a soft market. I'm talking about states where the fundamentals are so broken, so unsustainable, that buying a house there right now is like lighting your money on fire and hoping it somehow turns into wealth. Let me paint you a picture. Imagine you save up for 10 years. You scrape together a down payment. You're finally ready to achieve the American dream. You buy a house in one of these 5 states, and within 3 years, you're underwater on your mortgage. Your property taxes have doubled. Your insurance costs have tripled, if you can even get insurance at all. The value of your home hasn't just stagnated, it's dropped 20, 30, maybe even 40%, and now you're trapped. You can't sell without taking a massive loss. You can't afford to stay because the carrying costs are crushing you. You're stuck in a financial prison of your own making. And the worst part, this isn't a hypothetical. This is happening to people right now, today, as I'm recording this. Most people won't like hearing this, but I'm going to say it anyway. The housing market propaganda machine wants you to believe that real estate always goes up. They want you to believe that owning a home is always better than renting. They want you to believe that you can't lose if you just hold long enough. And you know what? That's garbage. Complete and utter garbage. Real estate is an investment like any other investment. And some investments are winners and some investments are losers. And right now, in these 5 states I'm about to reveal, the odds are stacked against you in ways that would make a Vegas casino blush. Here's what's really happening. We're seeing a fundamental restructuring of American geography. People are moving, businesses are relocating, tax bases are collapsing in some states while exploding in others. Climate change, whether you believe in it or not, is driving insurance costs through the roof in coastal and high-risk areas. Property taxes in blue states are becoming so astronomical that middle-class families literally cannot afford to stay. And meanwhile, the media, the real estate agents, the mortgage brokers, they're all still selling you the same old story. Buy now or be priced out forever. Rates are going up. It's now or never. And people are falling for it. They're making the biggest financial decision of their lives based on fear and outdated assumptions. Let me tell you what I've learned in 40 years of business and investing. When everyone is telling you to do something, when everyone is rushing in the same direction, that's usually when you need to stop and ask yourself if you're about to make a huge mistake. And right now, the housing market in these 5 states is screaming danger signals. But people aren't listening. They're too busy trying to keep up with their neighbors, too busy believing that homeownership is some kind of non-negotiable requirement for success. And that mindset is going to cost them everything. Now, before I reveal these 5 states, I need you to understand something. This isn't about politics. This isn't about left or right, red or blue. This is about money. This is about math. This is about cold, hard economic reality. I don't care what your political beliefs are. I don't care where you were born or where your family lives. What I care about is whether you're going to make a smart financial decision or a catastrophically stupid one. And if you're about to buy a house in one of these 5 states without understanding the risks, you're choosing stupid. And I'm not going to sugarcoat that for you. Here's another thing. The people who are going to get hurt the worst in these states are the middle class. The wealthy, they'll be fine. They can diversify, they can move, they can absorb losses. The poor, they're already renting, so they're somewhat insulated from this particular disaster. But the middle class, the people who are stretching themselves to buy a home, the people who are putting every dollar they have into a down payment, those are the people who are about to get absolutely crushed. And that's who I'm talking to right now. If you're middle class, if you're working hard, if you're trying to build wealth through home ownership, you need to hear this. The traditional advice used to be simple. Buy the most house you can afford in the best area possible. Get a fixed rate mortgage. Hold it for 30 years. Watch your wealth grow as you pay down the principal and the value appreciates. That was the formula. And for decades, it worked. But that formula is breaking down in these 5 states. It's breaking down because the underlying assumptions, the things that made that formula work, are no longer true. And if you apply old formulas to new realities, you lose. It's that simple. So what's different now? What's changed? Let me break it down for you. First, insurance. In several states, major insurance companies are literally pulling out. They're not renewing policies. They're not writing new policies. And the companies that are still there are charging premiums that would have been unthinkable 5 years ago. We're talking about insurance costs that are higher than the mortgage payment itself in some cases. Think about that. You're paying more to insure the house than you're paying to buy the house. How does that math work? It doesn't. That's the point. Second, property taxes. Some states are in such dire fiscal shape that they have no choice but to keep raising property taxes. And when I say raising, I don't mean a little bump here and there. I mean aggressive, sustained increases that are pricing longtime residents out of their own homes. You buy a house, you budget for the current tax bill, and then 3 years later, your taxes have gone up 50%. Your mortgage stayed the same, but your carrying costs just exploded. And what are you going to do? Sell? Good luck finding a buyer who wants to inherit that same problem. Third, population flight. When people leave a state, when businesses leave a state, the tax base shrinks. And when the tax base shrinks, the people who stay behind have to carry more of the burden. It's a death spiral. Less people means higher taxes, means more people leave, means even higher taxes. And if you own property in a state that's in this spiral, you're the one holding the bag. You're the one who gets stuck with the bill. Fourth, economic fundamentals. Some states have economies that are diversified and growing. Other states have economies that are dependent on dying industries or unsustainable government spending. If you buy real estate in a state with weak economic fundamentals, you're betting against the house, and the house always wins. Your property value is ultimately tied to the economic health of the area. If jobs are leaving, if incomes are stagnating, if the economy is contracting, your house isn't going to appreciate. It's going to depreciate, and you're going to lose. And fifth, this is the one nobody talks about, quality of life decline. When states mismanage their finances, when they raise taxes but services get worse, when crime goes up, when schools decline, when infrastructure crumbles, people notice, and when people notice, they leave, and when they leave, property values fall. You can't have a strong housing market in a state that people are actively trying to escape from. It's impossible. Now, I know what some of you are thinking. You're thinking, okay, this sounds bad, but surely it's not happening everywhere. Surely there are good deals to be found. Surely if I'm smart and I do my research, I can beat the odds. And to that I say maybe. Maybe you're the exception. Maybe you're the genius who's going to find that diamond in the rough, but probably not. Probably you're just another person who's going to learn an expensive lesson about why you shouldn't fight macro trends. The smart money isn't trying to find deals in broken markets. The smart money is avoiding broken markets entirely and focusing on places where the wind is at your back instead of in your face. This is the brutal truth. If you ignore this, you could spend the next decade of your life trying to dig yourself out of a financial hole. You could lose your down payment, you could damage your credit, you could end up in foreclosure, and for what? For the privilege of saying you're a homeowner? That's not wealth, that's ego, and ego is expensive. So here's what we're going to do. In the next section, I'm going to reveal the first 2 of these 5 states. I'm going to tell you exactly what's happening in each one. I'm going to show you the data. I'm going to give you the numbers, and I'm going to explain why buying real estate in these states in 2026 is a mistake you cannot afford to make. All right, let's get into it. The first state on this list, and this is going to upset a lot of people, is California. Now, before you start typing angry comments, hear me out. I'm not saying California doesn't have beautiful weather. I'm not saying it doesn't have great jobs in certain sectors. I'm not saying there aren't parts of California that are wonderful places to live. What I'm saying is this: for the average middle-class buyer in 2026, purchasing a home in California is one of the worst financial decisions you can make, and here's why. Let's start with the most obvious problem, the price. The median home price in California is over $800,000. Think about that for a second, $800,000. To afford that, you need a household income of at least $200,000 a year, and even then, you're going to be house poor. You're going to be spending 50, 60, maybe 70% of your take-home pay just on housing. That's not building wealth. That's indentured servitude with a mortgage attached. And that's before we even talk about property taxes, insurance, maintenance, and all the other costs of ownership. But here's where it gets really ugly. Property taxes in California are going up. And I'm not talking about the normal incremental increases. I'm talking about aggressive reassessments, special assessments, and local measures that are piling costs onto homeowners at a rate that's frankly unsustainable for most families. You might think, well, I've heard California has Prop 13. Doesn't that protect me? And yes, Prop 13 limits how much your property taxes can increase each year once you own the property. But here's the catch. When you buy, you're assessed at the current market value. So if you're buying an $800,000 house in 2026, you're getting taxed on $800,000. And in many California counties, the effective tax rate, when you include all the local bonds and assessments, is pushing 2%. That's $16,000 a year in property taxes alone, every single year, forever. Now let's talk about insurance. California is facing an insurance apocalypse. And I'm not exaggerating. Major insurers have stopped writing new homeowner policies in California. State Farm, Allstate, Farmers, they're either pulling back or pulling out entirely. Why? Because the risk of wildfires has made insuring California homes unprofitable. And when private insurance becomes unavailable, homeowners are forced into the California FAIR Plan, which is the state's insurer of last resort. And guess what? The FAIR Plan is more expensive and provides less coverage. In some high-risk areas, we're seeing annual insurance premiums of $10,000, $15,000, even $20,000. And that's if you can get coverage at all. Let me make this real for you. Imagine you buy a house in California for $800,000. You put down 20%, that's $160,000 out of your savings. Your mortgage is $640,000. At current interest rates, that's about $4,000 a month in principal and interest. Add $1,600 a month in property taxes. Add another $1,000 to $1,500 a month in insurance. You're at $6,500 to $7,000 a month in carrying costs. And we haven't even talked about maintenance, utilities, HOA fees if you have them, or saving for repairs and replacements. You need to be bringing home $10,000 a month after taxes just to not drown. And that's not living, that's surviving. But wait, it gets worse. California has the highest state income tax in the nation. If you're making the kind of money you need to afford that house, you're paying 13.3% state income tax on your top dollars. So not only are you paying a fortune for housing, you're also getting crushed on the income side. It's a double squeeze. High cost of living, high cost of housing, high taxes. And what are you getting for all that? Crumbling infrastructure, increasing crime in major cities, a homeless crisis that's out of control, and a state government that seems more interested in virtue signaling than actually solving problems. And here's the kicker. Property values in many parts of California have already peaked. The people who made money in California, real estate bought 10, 20, 30 years ago. They bought when prices were a fraction of what they are now. They rode the wave up. But if you're buying now at these inflated prices, where's your upside? You're not buying at the bottom. You're buying at or near the top. And when you buy at the top, the only direction to go is down or sideways. You're not building wealth. You're taking on massive risk for minimal potential return. Now let's talk about the second state, and this one might surprise you, Florida. I know. Everyone's moving to Florida, right? No state income tax, great weather, Republican governance. It's the promised land, except it's not. Florida's a trap, and if you buy real estate there in 2026 without understanding what you're walking into, you're going to regret it. Here's the problem with Florida. It's the same problem California has, but worse in some ways, insurance. Florida's insurance market is in complete meltdown. We're not talking about a crisis that's coming. We're talking about a crisis that's here right now today. Dozens of insurance companies have gone bankrupt in Florida in the last few years. The ones that are left are charging premiums that are 3, 4, 5 times the national average. And in coastal areas, which is most of the desirable parts of Florida, you literally cannot get affordable private insurance anymore. Let me give you some numbers. The average homeowner's insurance premium in Florida is now over $4,000 a year. But if you're in a coastal county, if you're anywhere near the water, you're looking at $8,000, $10,000, $12,000 a year. And that's if you can find coverage. Many homeowners are being forced into Citizens Property Insurance, which is Florida's state-run insurer of last resort. And Citizens is massively underfunded. If a major hurricane hits, and it's not a question of if but when, Citizens doesn't have the money to pay all the claims. They'll have to assess all policyholders to make up the shortfall. So not only are you paying high premiums, you're also taking on the risk of special assessments that could cost you thousands more. But let's say you're okay with that. Let's say you're willing to roll the dice on insurance. Here's the other problem. Property taxes in Florida are rising fast. People think Florida is a low-tax state, and it is when it comes to income tax. But property taxes are a different story. Florida has no income tax, which means the state has to raise revenue somewhere else. And where do they get it? Property taxes. And as more people move to Florida, as the population grows, the demand for infrastructure, schools, services, all of that goes up. And who pays for it? Property owners. Your property taxes in Florida are going up every single year, and they're going up faster than inflation. And here's something else nobody talks about. Florida's climate risk isn't just about hurricanes. It's about flooding. It's about sea level rise. It's about storm surge. If you buy a property in Florida, especially in a coastal area, you're buying into a long-term climate risk that's only going to get worse. And as that risk becomes more apparent, as the data becomes clearer, property values in high-risk areas are going to fall. Insurance companies aren't stupid. They're pulling out because the math doesn't work. And if the math doesn't work for insurance companies, it doesn't work for homeowners either. Let me be clear about something. I'm not saying everyone who buys in Florida is going to lose money. I'm saying the risk-reward ratio is terrible. You're taking on massive insurance risk, massive climate risk, massive special assessment risk, and rising property tax risk. And for what? The hope that your property might appreciate? That's not investing, that's gambling. And when you're gambling with hundreds of thousands of dollars with your life savings, you better make sure the odds are in your favor. In Florida, in 2026, they're not. Here's what people don't understand. When you buy real estate, you're not just buying a house. You're buying into a system. You're buying into a state's tax structure, its regulatory environment, its insurance market, its economic trajectory, its climate risk profile. All of these things matter. And in both California and Florida, multiple factors are aligning against the home buyer. It's not one thing. It's the combination of things. High prices plus high insurance plus high property taxes plus climate risk plus economic uncertainty. When you stack all of that up, the equation doesn't work. Now, some of you are thinking, okay, but what about the people who are already living there? What about the people who have family there, who have jobs there? And look, I get it. Not everyone has the luxury of picking up and moving to a different state. But here's what I'm saying. If you have a choice, If you have the flexibility to buy real estate anywhere, why would you choose a state where all the trends are working against you? Why would you choose to swim upstream when you could swim downstream? This is about being smart with your money. This is about understanding risk. This is about not falling for the hype, not falling for the narrative, not falling for what everyone else is doing. The crowd is usually wrong. The crowd buys at the top and sells at the bottom. The crowd follows trends instead of analyzing fundamentals. And if you want to build wealth, you cannot afford to be part of the crowd. Let me tell you something else. The real estate industry has a vested interest in you buying. Real estate agents make commissions when you buy. Mortgage brokers make money when you borrow. Home builders make money when they sell you a new construction property. The entire industry is set up to encourage you to buy, regardless of whether it's actually in your best interest. And right now, in California and Florida, it is not in your best interest, but they're not going to tell you that. They're going to tell you that prices only go up. They're going to tell you that if you don't buy now, you'll be priced out forever. They're going to tell you that renting is throwing money away. And all of that is designed to trigger your fear of missing out, to get you to make an emotional decision instead of a rational one. Don't fall for it. Don't let fear drive your biggest financial decision. Don't let ego drive it either. Homeownership is not a requirement for success. It's not a badge of honor. It's a financial decision. And like any financial decision, it should be based on math, on data, on a clear-eyed assessment of risk and reward. And when you run the numbers on California and Florida in 2026, the numbers don't work. Now, I've given you 2 of the 5 states. I've shown you why California and Florida are dangerous places to buy real estate right now, but we're not done. There are 3 more states on this list, 3 more places where buying a home could be a financial disaster. And in the next section, I'm going to reveal states 3 and 4. I'm going to show you why the problems in those states are different, but just as serious. And I'm going to give you the information you need to make a smart decision about where not to put your money. State number 3 is going to make a lot of people angry, but I don't care because this is about your money, not about feelings. New York. And when I say New York, I'm talking about the entire state, but especially the New York City metro area and the surrounding counties. If you're thinking about buying real estate in New York in 2026, you need to understand that you're buying into a state that is in serious fiscal trouble. And when a state is in fiscal trouble, homeowners pay the price. It's that simple. Let's start with the most obvious issue, property taxes. New York has some of the highest property taxes in the entire country. We're not talking about a little bit higher. We're talking about double, sometimes triple what you'd pay in other states. The average property tax bill in many New York counties is over $10,000 a year. In some wealthy suburbs like Westchester County or Long Island, we're talking about $20,000, $30,000, even $40,000 a year in property taxes. Think about that. $40,000 a year just in property taxes. That's more than many Americans make in total income. And you have to pay that every single year for as long as you own the property. But here's what makes it even worse. Those property taxes are going up. Why? Because New York is hemorrhaging population. People are leaving, high earners are leaving, businesses are leaving. And when your tax base shrinks, the people who stay have to pay more to maintain the same level of services. It's basic math. Fewer people paying in means higher taxes for everyone else. And if you buy property in New York right now, you're signing up to be one of the people left holding the bag. Now, let me ask you something. What are you getting for those insanely high property taxes? Are you getting excellent schools? In some districts, yes. In others, no. Are you getting great infrastructure? Have you driven on New York roads lately? They're falling apart. Are you getting low crime? Not in New York City. Crime has been rising. Quality of life has been declining. And yet the taxes keep going up. You're paying more and getting less. That's a losing proposition. But wait, there's more. New York State has a massive pension crisis. They have billions, and I mean billions of dollars in unfunded pension liabilities. They've made promises to public employees that they cannot keep without massive tax increases. And guess who's going to pay for those pensions? Property owners, business owners, high earners, the people who can't escape. And if you buy property in New York, you're volunteering to be part of that system. You're volunteering to fund a pension system that's completely unsustainable. Let's talk about the New York City market specifically. Real estate prices in Manhattan and the desirable parts of Brooklyn are still sky high. But here's the problem. The fundamentals don't support those prices anymore. The work from home revolution has changed everything. Companies are downsizing their office space. People are realizing they don't need to pay $3, $4, $5 million for a two-bedroom apartment when they can live somewhere else and work remotely. The commuter traffic into the city is down, retail is struggling, the office vacancy rate is at record highs, and when offices are empty, when people aren't commuting, when businesses are closing, the tax base erodes. And what happens when the tax base erodes? Property taxes go up for everyone else. Here's the thing about New York real estate. For decades, it was a safe bet. You bought in Manhattan, you held it, and it appreciated. It was almost guaranteed. But that guarantee is gone. The pandemic changed the game. Remote work changed the game. And now you're looking at a market where prices are still high, but the underlying demand is weakening. You're buying at prices that were set during a different era, when people had no choice but to live in the city if they wanted access to certain jobs. That's not true anymore. And as more people figure this out, as more companies embrace permanent remote work, the demand for expensive New York real estate is going to continue to decline. And let's not forget about rent control and rent stabilization. New York has some of the most tenant-friendly laws in the country. If you're buying an investment property, if you're thinking about being a landlord in New York, you need to understand that the laws are completely stacked against you. You can't easily raise rents. You can't easily evict problem tenants. The government treats landlords like they're the enemy, and when you create a hostile environment for landlords, you destroy the economics of rental property investing. So if you were thinking about buying a multifamily property or a rental unit in New York, think again. The numbers don't work. Now let's move to state number 4, Illinois, and specifically the Chicago area and Cook County. Illinois is a disaster. I'm not being dramatic. The state is a fiscal basket case. It has the worst credit rating of any state in the nation. It has massive unfunded pension liabilities that make New York look responsible by comparison. And it has a history of solving budget problems by raising taxes on the people who are least able to leave, which is property owners. Here are the facts. Illinois has been losing population for years. People are leaving for lower tax states like Texas, Florida, Tennessee, and Arizona. And when people leave, the tax base shrinks. And when the tax base shrinks, the government has two choices: cut spending or raise taxes. And Illinois doesn't cut spending, it raises taxes. That's what it always does. And if you own property in Illinois, you're the target. Property taxes in Cook County, which includes Chicago, are among the highest in the nation, and they keep going up. The average effective property tax rate in Cook County is over 2%. In some suburbs, it's closer to 3%. That means if you buy a $500,000 house, you're paying $10,000 to $15,000 a year in property taxes, and that number is going up every year. There's no end in sight. But here's what's really scary about Illinois. The state is so broke that there's a real risk of a fiscal crisis. They can't pay their bills. They have billions in unpaid obligations. They've borrowed from the pension funds. They've delayed payments to vendors. They've used every accounting gimmick in the book to avoid dealing with reality. And at some point, reality is going to catch up. And when it does, one of two things is going to happen. Either they're going to have to massively cut services, or they're going to have to massively raise taxes, probably both. And if you're a property owner in Illinois, when that happens, you're going to be in serious pain. Let's talk about Chicago specifically. Chicago used to be a great city, world-class architecture, great food, amazing culture, but the city is in decline. Crime is a major problem. Businesses are leaving. The population is shrinking. Downtown office buildings are half empty. Retail corridors that used to be vibrant are now struggling, and the city government keeps raising taxes to try to plug budget holes. It's a death spiral. Higher taxes drive more people out, which means less revenue, which means higher taxes, which drives more people out. If you buy real estate in Chicago right now, you're betting that this trend is going to reverse, and I'm telling you it's not. Here's another factor that people don't think about. Climate and location aside, Illinois has no natural competitive advantage anymore. It used to be a transportation hub. It used to be a manufacturing center, but those industries have changed. Manufacturing has moved overseas or to lower-cost states. Transportation and logistics have become less location-dependent. The industries that made Illinois prosperous in the 20th century are not the industries that are going to drive growth in the 21st century. And if you're buying real estate in a state with no economic growth engine, you're buying into stagnation at best, decline at worst. Let me make this very clear. Both New York and Illinois are in a fiscal death spiral. Their governments have made promises they cannot keep. They have pension obligations they cannot fund. They have infrastructure needs they cannot afford. And the only way they know how to deal with these problems is to raise taxes on the people who can't leave. And who are the people who can't leave? Homeowners, people with deep roots, people with businesses tied to the local economy. If you buy property in these states, you're making yourself a target. You're volunteering to pay for decades of government mismanagement. Now, I know what some of you are thinking. You're thinking, but what about the affordable areas? What about upstate New York or downstate Illinois? Surely there are bargains to be found there. And yes, you can find cheaper real estate in those areas. But here's the problem. Those areas are cheap for a reason. They're economically depressed. They're losing population. They have no job growth. You can buy a house in upstate New York for $150,000. Great. But what are you going to do for work? Where are your kids going to find jobs? What happens when the only employer in town closes down? Cheap real estate in a dying economy is not a bargain. It's a trap. Here's the fundamental principle you need to understand. Real estate value is driven by economic opportunity. If an area has good jobs, growing businesses, increasing population, rising incomes, real estate values will go up. If an area has declining employment, shrinking population, stagnant incomes, real estate values will go down or stay flat. It's not complicated, and both New York and Illinois, with a few small exceptions, are in the declining category. The trends are all pointing in the wrong direction. Let me give you a comparison. Think about Texas. No state income tax, business-friendly policies, population growing, jobs growing, companies relocating there. That's an environment where real estate can appreciate because the fundamentals are strong. Now compare that to New York and Illinois. High taxes, business-unfriendly policies, population declining, jobs leaving, companies fleeing. Which environment would you rather invest in? It's not even close. And here's another thing. When you buy real estate, you're making a long-term bet. This isn't a stock you can sell tomorrow if things go wrong. This is a 30-year commitment for most people. 30 years of property taxes, 30 years of maintenance, 30 years of dealing with whatever policies the state government decides to implement. And if you're making a 30-year bet on New York or Illinois, you're betting that somehow, some way, these states are going to turn things around, that they're going to fix their pension problems, that they're going to stop raising taxes, that they're going to become business-friendly, that they're going to attract new residents instead of driving them away. Do you really think that's going to happen? Because I don't. The definition of insanity is doing the same thing over and over and expecting different results. New York and Illinois have been doing the same thing for decades. Tax and spend, make promises they can't keep, burden businesses and property owners. And the results have been the same. People leave, businesses leave, the tax base shrinks, and they respond by doing more of the same. If you're expecting that pattern to change, you're delusional. And if you're basing a major financial decision on that delusion, you're going to lose. Most people won't like hearing this. People have emotional attachments to places. They grew up there. Their families are there. They have memories there. And I get that. I'm not saying these are bad places to visit or bad places to have history with. What I'm saying is they're bad places to park hundreds of thousands of dollars of your hard-earned money. Emotion and money don't mix. When you let emotion drive your financial decisions, you lose. It's that simple. So here's where we are. I've given you 4 of the 5 states: California, Florida, New York, and Illinois. 4 states where buying real estate in 2026 is a high-risk, low-reward proposition. But there's one more state that might surprise you. One more place where the warning signs are flashing red. And in the final section, I'm going to reveal that 5th state. I'm going to tie everything together. And I'm going to give you the action steps you need to protect yourself and make smart decisions about real estate going forward. All right, here we are, the fifth and final state on this list. And this one is going to shock a lot of people because it's a state that's been getting incredible press lately. Everyone's talking about how great it is, how people are flooding in, how it's the future of America. I'm talking about Texas. That's right, Texas. And before you lose your mind, before you start telling me I don't know what I'm talking about, let me explain exactly why Texas belongs on this list in 2026. Now, I'm not saying Texas is as bad as California or Illinois. It's not. Texas has no state income tax. It has a generally business-friendly environment. It has been attracting people and companies from high-tax states. All of that is true. But here's what nobody's telling you. The Texas real estate market has become dangerously overheated. And when markets overheat, when prices get disconnected from fundamentals, bad things happen. And if you're buying in Texas right now at these inflated prices, you're setting yourself up for pain. Let me give you some numbers. In Austin, the median home price went from $400,000 in 2019 to over $600,000 by 2022. That's a 50% increase in 3 years. In Dallas, in Houston, in San Antonio, we saw similar explosive growth. And yes, some of that was justified by population growth and demand, but a lot of it was speculation. A lot of it was people buying because they were afraid of missing out. A lot of it was investors gambling on continued appreciation. And now in 2026, we're seeing what happens when that speculation meets reality. Prices have started to flatten. In some areas, they've started to decline, and people who bought at the peak are already underwater. But let's talk about the bigger problem with Texas, property taxes. Everyone focuses on the fact that Texas has no income tax, and they forget that the state has to raise revenue somewhere. And where do they get it? Property taxes. Texas has some of the highest property tax rates in the entire country. The average effective property tax rate in Texas is around 1.8%. In some counties, it's over 2%. That means if you buy a $500,000 house in Texas, you're paying $9,000 to $10,000 a year in property taxes. And unlike states with income tax where high earners pay more, in Texas, everyone with property pays through the nose. And here's the kicker. Those property taxes are going up fast. As more people move to Texas, as the population explodes, the demand for infrastructure goes up. Roads, schools, water systems, power grids, all of that costs money. And who pays for it? Property owners. Your property taxes in Texas are going up every single year, and there's no Prop 13 like California to protect you. Your home gets reassessed, the value goes up, your taxes go up, it's automatic. And if you're on a fixed income, if you're a retiree, if you're someone who bought thinking your costs would be predictable, you're in for a rude awakening. Let me tell you about another problem in Texas that nobody wants to talk about, the power grid. Texas has an independent power grid. They're not connected to the rest of the country the way other states are, and that grid is fragile. We saw what happened in 2021 when the winter storm hit. The grid failed. People froze to death in their homes. And since then, has the state fixed the problem? Not really. They've made some improvements, but the fundamental issues remain. The grid is underinvested. It's poorly regulated. And as the population continues to grow, as demand continues to increase, the risk of another catastrophic failure grows with it. Now, why does this matter for real estate? Because when people start to question the reliability of basic infrastructure, when they start to wonder if their power is going to work when they need it, it affects property values, it affects desirability, and it affects your ability to sell if you need to get out. If you're trying to sell a house in Texas and the news is full of stories about power outages and grid failures, good luck finding a buyer willing to pay top dollar. Here's another issue, water. Texas is facing serious water scarcity problems, especially in Central Texas around Austin and San Antonio. As the population has exploded, as development has accelerated, the water supply hasn't kept pace. We're seeing aquifer levels dropping. We're seeing municipalities implementing restrictions, and climate change, regardless of your views on it, is making droughts more frequent and more severe. If you're buying property in an area with long-term water supply questions, you're taking on a risk that most people aren't even thinking about. Let's talk about the major Texas metros individually for a minute. Austin. Austin has become wildly expensive. It's no longer the affordable alternative to California that it was 10 years ago. You're paying California prices without California weather or California amenities. And the tech boom that drove Austin's growth, that's cooling off. Tech companies are laying off workers. They're pulling back on expansion plans. The office buildings that were supposed to be filled with high-paid tech workers are sitting empty. And as that sector contracts, what happens to all the real estate that was built on the assumption of continued tech growth? It becomes overpriced and oversupplied. Dallas has sprawl issues. The metro area just keeps spreading out, which means longer commutes, more infrastructure costs, and a dilution of property values as new development competes with existing housing stock. And Dallas has high property taxes, even by Texas standards. Some suburbs have effective tax rates well over 2%. You're paying California-level property taxes without California-level appreciation potential. Houston's economy is heavily tied to energy. And while energy will always be important, the transition away from fossil fuels is happening. It's happening slowly, but it's happening. And if you're buying real estate in a city whose economy is dependent on an industry that's facing long-term headwinds, you're taking on risk. Plus, Houston has flooding problems, major flooding problems. We've seen it multiple times in the last decade. And as climate patterns shift, those flooding risks are increasing, not decreasing. San Antonio is more affordable than Austin or Dallas, but it also has fewer high-paying jobs. It's more dependent on military installations and tourism. The economic base is narrower, and narrow economic bases mean higher risk if something goes wrong. Here's the fundamental problem with Texas in 2026. Everyone thinks they discovered the secret. No income tax, business-friendly, people are moving there. Must be a great place to buy real estate. And when everyone thinks the same thing, when everyone rushes to the same conclusion, that's when you get bubbles. That's when you get overvaluation. That's when you get situations where people are paying tomorrow's prices for today's property based on yesterday's trends. Let me be very clear about something. I'm not saying Texas is a bad state. I'm not saying it doesn't have advantages. What I'm saying is that the real estate market in Texas has gotten ahead of itself. Prices have risen too fast, property taxes are too high and getting higher, infrastructure is struggling to keep up with growth, and if you buy now at these prices, your upside is limited and your downside risk is significant. Here's what smart money does. Smart money waits. Smart money watches. Smart money doesn't chase trends. Smart money looks for situations where the risk reward is favorable. And right now in Texas, the risk reward is not favorable. You're paying peak prices. You're taking on high property taxes. You're betting that growth will continue at the same pace it has for the last 5 years. And that's a bad bet. Growth doesn't continue forever. Markets correct. And when Texas corrects, and it will correct, the people who bought at the top are going to lose. So there you have it, the 5 states: California, Florida, New York, Illinois, and Texas. 5 states where buying a home in 2026 is a mistake. Now, what do these 5 states have in common? Let me break it down for you. They all have at least one of these problems: extremely high property taxes, insurance market collapse or sky-high insurance costs, population loss or unsustainable population growth that's straining infrastructure, fiscal mismanagement at the state level, overheated real estate markets where prices have disconnected from fundamentals, climate risks that are driving up costs and affecting property values. And here's what you need to understand. These aren't temporary problems. These aren't things that are going to get fixed in a year or two. These are structural issues. These are long-term trends. And if you buy real estate in a state with structural problems, you're going to be fighting an uphill battle for decades. Now, let me tell you what you should do instead. First, if you're thinking about buying a home, look at states with strong fundamentals: low taxes, fiscal responsibility, diversified economies, affordable insurance markets, reasonable property tax rates. States like Tennessee, North Carolina, certain parts of Arizona, parts of Nevada, Idaho, Utah. These are states where the fundamentals are solid, where the government isn't drowning in debt, where property taxes are manageable, where you're not betting against macro trends? Second, if you're in one of these 5 states already and you own property, you need to seriously evaluate whether it makes sense to stay. I know that's hard. I know you have roots. But you have to ask yourself, am I willing to pay higher and higher taxes every year for declining services? Am I willing to watch my insurance costs spiral out of control? Am I willing to risk my property value declining while my carrying costs increase? These are not easy questions, but they're necessary questions. Third, if you're absolutely committed to buying in one of these states, and I understand some people don't have a choice, then you need to go into it with your eyes open. You need to understand that you're making a defensive decision, not an offensive one. You're not buying to build wealth. You're buying because you need a place to live and you're willing to accept the risks. Fine. But don't fool yourself into thinking it's a great investment. It's not. Fourth, diversify. If you're buying real estate, don't put all your eggs in one basket. Don't buy in just one state. Don't bet everything on one property in one location. Spread your risk. And if you're young, if you're mobile, if you have the flexibility, choose wisely. Choose a place where the wind is at your back, not in your face. Let me leave you with this. Real estate is the biggest financial decision most people will ever make. It's not just about having a place to live. It's about building wealth. It's about creating security for your family. It's about setting yourself up for retirement. And if you make the wrong decision, if you buy in the wrong place at the wrong time, it can set you back decades. It can destroy your financial future. And that's not being dramatic. That's reality. The 5 states I've outlined today, California, Florida, New York, Illinois, and Texas, these are places where the odds are stacked against you. The math doesn't work. The trends are unfavorable. The risks are too high. And if you ignore this warning, if you buy anyway because everyone else is doing it or because you're emotionally attached or because some real estate agent told you it's a great time to buy, then that's on you. I've given you the information. I've shown you the data. I've explained the risks. What you do with that information is your choice. But here's my final word. Protect your money. Be smart. Don't follow the crowd. Don't let emotion override logic. Don't let fear of missing out drive you into a bad decision. The American dream of homeownership is only a dream if it actually builds wealth and creates security. If it does the opposite, if it traps you in debt and declining property values and rising costs, then it's not a dream. It's a nightmare. And I don't want that for you. If this video helped you, if it made you think, if it potentially saved you from making a huge mistake, then do me a favor. Hit that like button. Subscribe to this channel because I'm going to keep telling you the truth even when it's uncomfortable. Drop a comment below and let me know which state you're in and whether you agree or disagree with my analysis. I want to hear from you. And share this video with someone who needs to see it. Share it with someone who's thinking about buying a house. Share it with someone who needs a reality check, because the more people who understand what's really happening in these real estate markets, the fewer people are going to get hurt. And if you're serious about your financial future, if you're serious about building real wealth and not just following what everyone else is doing, then stick around. Watch my other videos. Learn, educate yourself, because knowledge is power. And in the real estate market of 2026, you need every advantage you can get. Don't be a victim. Don't be someone who learns these lessons the hard way. Be smart, be informed, and protect your financial future. That's it from me. Now go make good decisions.